So what are the ways that you can buy a new home before selling your current house? When the real estate market is hot like it is right now, there can be a tremendous amount of competition among buyers. Buyers looking to upgrade within the same popular neighborhood or move to a more desirable area may be feeling a lot of pressure, especially as interest rates tick higher. But although many buyers feel that they probably can sell their home in a weekend, they're worrying about their ability to secure a new property. And if you need to use equity from your current house to purchase your future home, you may be wondering what your options are. One of the most common ways to buy a new home before selling your old one is to use a home equity line of credit, or HELOC. Now, with a HELOC, you can tap a portion of your home's equity without selling the home. Most lenders will only let you borrow up to 80% of the home's loan to value on the property. And some lenders will even allow you to take out a home equity line of credit on the new house that you're purchasing. The pros of this strategy is that interest rates are still relatively low, and most borrowers can get a HELOC fairly quickly as long as they haven't already listed their home. If they have listed their home for sale, then this actually won't be an option for you. The downsides of using a home equity line of credit is that you're adding leverage on your home and increasing your risk of possibly becoming underwater if you don't sell your house for the anticipated price that you can sell it for. Also, getting a HELOC will impact your credit score when you do go to apply for a mortgage on your new home. Your debt to income ratio will also be affected as well, since you will have this new debt payment from the HELOC, or at least an expected future one. So it'll be really important to work with your lender to make sure that all the numbers still work. Now keep in mind, under the new tax law, interest on home equity loans may only be deductible if the proceeds from the loan is used to acquire or substantially improve your home. So it's really critical to keep meticulous records here if you'd like to deduct the interest. Now, also as part of the new tax code, there are limits on the overall mortgage interest that you can deduct, and that includes the home equity line of credit for a maximum indebtedness of $750,000. Another way that buyers can access cash to buy a new home is from taking a loan from their 401k plan. Assuming the plan allows for it, so you'll want to make sure that you read the terms of the plan and find out the payback period, what interest rate applies, and any other associated terms. The amount that you can borrow will also depend on your specific 401k plan. It just can't exceed the IRS guidelines, which is either the greater of $10,000 or 50% of your vested balance, or $50,000, whichever is less. Now, although tapping your 401k won't impact your debt to income ratio for many lenders, this strategy can really have a lasting impact on your retirement savings. Most plans do require loans to be repaid by payroll deductions, so this could take years just to make yourself whole again. And once you consider the loss of the compounding and the savings from those years that you effectively weren't contributing, the impact on your portfolio can really be substantial. You'll also need to carefully examine your cash flows to make sure that repaying your 401k loan within the terms is feasible with your new home and your other expenses. And if you do decide to leave your job, the loan will typically become due and payable immediately. So you'll really need to make sure that fits into your overall career plans. There are two other ways to get a down payment together, although it may end up hurting your ability to either make or receive a very competitive offer. So certainly ask your real estate agent for advice there, and certainly work with your lender as well. One way to do this is ask for a sale-leaseback contingency. Now, with a sale-leaseback contingency, you will ask potential buyers to essentially allow you to remain in your current home, and you will rent it from them for a period of time after the closing. This will allow you to get cash out of your home to use as a down payment on a new property, but of course you still will have a time limit on how long you can stay. Your rent that you'll be paying to the new owner will be closer to the current market rate and won't necessarily be what you're currently paying on your mortgage. So the second option is to consider putting down less than 20%. Buyers at higher price points may not have this option, so certainly check with your lender and the conforming loan limits in your county. Putting down less than 20% usually means that you'll also have to pay private mortgage insurance, or PMI. But for buyers who put down at least 10%, the PMI should fall off when the loan to value reaches 78%. But again, you'll really want to make sure to check with your lender. You'll also want to talk to a bunch of different lenders because they always offer different programs, and interest rates can really vary just in between lenders. So it's really important to shop around without having them do a hard pull on your credit. Really just remember, as you're looking for your new home, it's really important to make sure that you're not stretching yourself too thin financially. You never know what's going to come up in terms of repairs, and there are certainly closing costs and other unexpected expenses, and you just really want to make sure you're not ending up house poor.